We have been talking about the retirement of a partner, and under the retirement of a partner, we saw the various adjustments which are required for retirement of a partner. We talked about adjustment in regards to goodwill. We've solved a couple of sums, and then we talked about adjustment in regard to revaluation of assets and liabilities, where we saw the revaluation account, memorandum revaluation account, and then we also saw adjustments with regards to undistributed profits and losses, wherein if there are any profits, reserves, or any losses in the existing balance sheet, or even in the adjustments if they have been mentioned, how we're going to be distributing them. And then we also saw in case of joint life policy, if a partner retires before the maturity of the joint life policy, they're going to be getting an amount termed as your surrender value, and that will be distributed amongst your partners. So we are in the last adjustment, which is adjustment in regard to share of profits from the date of the last balance sheet to the date of retirement. So basically, we are dealing with interim profits at this point. In the previous session, when we talked about interim profits, we learned about the meaning of interim profits, the profits which we are getting from the date of the starting of the financial year until the date of retirement of the partner is your interim profit. And we saw there are two methods in which we can calculation based upon past profits and calculation after preparing interim final accounts. Okay, so let's look at a question first. A, B, and C are partners sharing profits and losses in the ratio of 2:2:1. C will retire on 31st of March 2015. The balance sheet as on 31st of March 2014 is as follows. So you have your balance sheet there. Liabilities and assets. On the liabilities side, you have capital accounts A, B, and C, 60,000, 60,000, 40,000 respectively. Then you have a general reserve, 40,000. You also have creditors of 10,000. And on the asset side, you have land and buildings, 1 lakh. Investments, 12,500. Stock, 25,000. Debtors, 40,000. Cash at bank, 22,500. And cash in hand, rupees 10,000. Now, in order to arrive at the balance of due to C, it was mutually agreed that land and buildings will be valued at rupees 1,20,000, investments will be valued at rupees 10,000, stock to be taken at rupees 30,000, goodwill will be valued at 2 years' purchase of the average profit on the basis of the average profit of the preceding 3 years. Goodwill will not appear in the books of the new firm. And then point number C. 3. C shares a profit up to the date of retirement to be calculated on the basis of average profit of the preceding 3 years. And then the profits of the preceding 5 years are, for 2015, you have 20,000, 2011, you have 0, nil, and then, okay, there was a mistake there. The profits of the preceding 5 years are 2015, rupees 20,000. 2011, it is rupees 23,500. That 0 should not exist. And then 2012 is rupees 30,000. 2013, rupees 27,500. And for 2014, you have rupees 32,500. Amount payable to C to be transferred to his loan account carrying interest at the rate of 15% per annum. Prepare the revaluation account, partners, capital account, and balance sheet as on 31st of March 2015. Okay, so you have to prepare the revaluation account, check which are the assets that are going to be affected, and then you have to prepare your partners' capital accounts also. So make sure you're checking what all should be shared amongst your partners, and then after that, the balance sheet. So let's start with the revaluation account. So in case of revaluation account, you have point number 1, land and buildings valued at rupees 1,20,000. So original value of land and buildings was rupees 1 lakh, now is increased to rupees 1,20,000. So there is an increase in the value of land and building. So it will be by land and building account. By land and building account, 1,20,000, new value minus old value, rupees 1 lakh. So rupees 20,000 is the amount of increase. Additionally, investments are to be valued at rupees 10,000. So in case of investments, your assets, you had 12,500. Now it's valued at 10,000, which means there is a decrease. So write down to investments account. To investments account, 12,500 minus 10,000. Change is rupees 2,500. And then stock is to be taken at rupees 30,000. Original value of stock 25,000. Now it has changed to 30,000, which is an increase. Therefore, by stock account, increase is 30,000 minus 25,000. So increase is rupees 5,000. Okay, so there are no other changes in the values of our assets and liabilities. So let's close down the revaluation account. Total of revaluation comes to rupees 25,000 and the balancing figure is rupees 22,500. And this amount of 22,500, we have to divide it in the all profit sharing ratio amongst your partners. That is ratio of 2:2:1. Therefore, let's write down 2 partners capital account. 2 partners capital account. Partner A, partner B, partner C. So the total balancing figure is rupees 22,500. In the ratio of 2:2:1, we're getting for partner A 9,000. Similarly, again for partner B also 9,000. And for partner C, it comes to rupees 4,500. Okay, so that is your revaluation account. Next, they've also asked us to prepare your partners' capital accounts. So let's start with the partners' capital accounts. Remember, when we're starting with partners' capital accounts, we always start with the opening balance. Therefore, let's write down by balance brought down. By opening balance or balance brought down. For A, it's been given in the old balance sheet, 60,000. For B also, it was given as 60,000. And for C, it was rupees 40,000. So let us also record your revaluation account, the amount you're getting on revaluation. So let's write it as by revaluation account. By revaluation account, it was rupees 9,000 respectively for A and B, and rupees 4,500 for partner C. Alright, so we've recorded opening balance, we've recorded your revaluation account. Okay, next come back to the old balance sheet and see if there are any undistributed profits or losses. So in the old balance sheet, we had a general reserve of rupees 40,000. As we've been saying, general reserve is for all of your partners. Therefore, on the death or on retirement, it should be divided or distributed. So let's write that down. By general reserve account, amount is rupees 40,000. It should be divided in the old profit sharing ratio, 2:2:1. So based upon that old profit sharing ratio, A and B will be getting rupees 16,000 each. So that leaves C with rupees 8,000 of your general reserve. So there are no other there are no other profits or losses undistributed in the old balance sheet. So moving on, let's come to the adjustments. So adjustment number 1 has been completed. Adjustment number 2. Goodwill will be valued at 2 years purchase of average profit on the basis of the average profit of the preceding 3 years. And goodwill will not appear in the books of the new firm. So they've given to you that goodwill should be calculated 2 years purchase based on average profit of preceding 3 years. So they've given you profits for preceding 5 years. Now let us calculate based upon only your preceding 3 years. Okay, so start a working note, calculation of goodwill. So let's calculate the goodwill based upon the 5 years average profit. So calculation of goodwill, firstly we have to calculate the average profit. And you have already been given the profit for the past 5 years. You have 20,000, 23,500, 30,000, 27,500 and 32,500. So 20,000 plus 23,500 plus rupees 30,000 plus 27,500 and 32,500, and entire thing divided by 5 will give you average profit of rupees 26,700. And goodwill is going to be based upon 2 years purchase of average profits. Therefore, goodwill is equal to 26,700 multiplied with 2 for 2 years purchase is equal to rupees 53,400. Okay, so goodwill we've calculated is going to be equal to rupees 53,400. And in the question, it was given that goodwill will not appear in the books of the new firm. So which means that goodwill has to be written off. Okay, it has to be raised in the old profit sharing ratio and it should be written off in your new profit sharing ratio. So firstly, let us write up your goodwill amount. So goodwill will be by goodwill account amount you've already calculated it to come to rupees 53,400. So 53,400 divided in the ratio of 2:2:1 will give you rupees 21,360 for partners A and B respectively, and for partner C it comes to rupees 10,680. Okay, remember in the old profit sharing ratio it is written up, and now let us write it off to goodwill account. We'll write it off in your new profit sharing ratio, which C has retired, and the new profit sharing ratio in the question, let's look at the question once again. It has not been given, therefore we're going to assume it's going to be shared equally. So now let us share this goodwill amount 53,400. It'll be 26,700 to A and B respectively. They're sharing in the ratio of 1:1 or equal sharing. And next, point number 3 also states that C's share of profit up to the date of retirement to be calculated on the basis of average profit of the preceding 3 years. And they've given you the profits again, the same amount of profits that we used for calculating goodwill. So open another working note calculation of C's share of profits. Okay, remember C's share of profit up to the date of retirement. And in the balance sheet, it's given balance sheet is up to 31st of December 2015, so 2013, sorry. So they are following the calendar year, but he retired on 31st of March 2015. Okay, he decided to retire in between the year. So let us calculate the profit for these years. Firstly, let us calculate the average profit. So average profit. Now the reason we're calculating average profit once again is because we are calculating it now based upon preceding 3 years only. Okay, not your 5 years. So let's write it for 3 years. It'll be equal to rupees 30,000 plus rupees 27,500 plus rupees 32,500 for the years before your retirement. So before 2015, you have 2014, 13, 12 amounts, 32,500, 27,500 and 30,000. We are going to take only these amounts because they said 3 years, right? So 30,000, 27,500 and 32,500. Entire thing will divide with 3. So average profit for 3 years is going to be equal to rupees 30,000. Okay, so now for 3 years we have the average profit. Next we have to calculate the interim profit. So profit from the date of the starting of the financial year until the date of retirement. So now you calculate profit for, now how many months has elapsed? So you are starting in the calendar year, January you're starting, and he retired on 31st of March. So January full month, February full month, March also full month because he's retired on 31st of March, right? So you're getting 3 months. So profit for 3 months. You can also write it as profit for January, February, and March. Okay, you can write it as profit for 3 months, or you can write it as profit for January, February, and March. Whichever is easier, whichever you feel comfortable. So profit is going to be equal to average profit 30,000 into how many months are there? 3. And entire year there are 12 months. So into 3 divided by 12 is equal to rupees 7,500. And this is the total profit that the firm is earning, okay, that A, B, and C are earning together for the months of January, February, and March. Now, this rupees 7,500 should be divided amongst your partners in order to figure out how much your retiring partner is getting. So, the retiring partner is C, right? So, C's share of profit, C's share of profit is equal to, what is his ratio? 2:2:1. So, his share is 1/5 of the profit for 3 months of rupees 7,500. So this will be equal to rupees 1,500. This is C's share in the profits. Now remember, it is an interim profit. Okay, so this will be transferred to our profit and loss suspense account. All right, please remember, it is an interim profit. All interim profits are temporary profits, and we have not yet closed the books of account, so we cannot transfer them to profit and loss account. We have to transfer them to profit and loss suspense account. So write down by profit and loss suspense account. And it was only for partner C that we calculated. So profit and loss suspense account for partner C is rupees 1,500. So we have recorded the opening balance, we've recorded the revaluation account, we've also transferred the general reserve, which was your undistributed profits, and we have also recorded the goodwill. We have written up the goodwill, we have written off the goodwill, and we have also calculated the profit and loss for the retiring partner. Okay, so now we have completely recorded all of your transactions and the adjustments also. So let's close down the partner's capital account. What is the total? Okay, so in case of partner A, the total should come to rupees 1,06,360. Okay, rupees 1,06,360. And in case of partner B, our total comes to rupees 1,06,360 once again. 1,06,360. They're sharing the same ratio, so basically it should come to the same amount only. And then for partner C, it comes to rupees 64,680. 64,680. Okay, so let's calculate the balancing figures. So two balance carried down. To balance carried down only for our continuing partners A and B. C will be getting a loan account. So to C's loan account. Alright, so let us now calculate the balancing figure. In case of A, 1,63,060 rupees, 1,06,360 rupees, and the balance will come to rupees 79,660. In case of B also, same amount, goodwill amount also is the same, so balancing figure is rupees 79,660, both for A and B. And in case of C, to his loan account, the balancing figure is rupees 64,680 itself. Alright, so this is our partner's capital account. Next, let us start with the preparation of your balance sheet. So in case of the balance sheet title will be Balance Sheet of A and B as on 31st of March 2015. Okay, so let's start with your liabilities side. On your liabilities side, you have capitals as usual. So capitals, and you have two continuing partners, A and B. Partner A and B are sharing equally, and their amounts are also equal, which is 79,660. And then partner C has a loan account, 15% C's loan, amount of rupees 64,680. And in the old balance sheet, we also have an amount for creditors, which is untouched. So creditors rupees 10,000. It is recorded at original figure in the new balance sheet. Okay, so moving on. Now let us write up our assets account. Our asset side. So under the asset side, firstly, you have the first asset is land and buildings. Now, in case of land and buildings, you had an increase of 20,000 and the next new figure is rupees 1,20,000. And next you have investments. In case of investments also, we had a revaluation. Originally 12,500, it was reduced by 2,500 and now we have investments worth rupees 10,000 only. And the next asset is our stock. In case of stock, it has increased to the extent of rupees 30,000. And then we have debtors. In case of debtors, it was originally 40,000 and there was no change. So we're recording the original figure, rupees 40,000. And then you have cash at bank. There was no transaction relating to cash in hand, cash at bank. So it's given as 22,500 from the old balance sheet. Similarly, in case of cash in hand also. In case of cash in hand, it was 10,000. We're recording the same amount. Okay, so there was a new account that you've opened, your profit and loss suspense account, for recording the profit of your retiring partner. That profit and loss suspense account we will have to record as on 31st of March. Okay, this is interim period as at 31st of March 2015. This is the interim period, so this is your interim balance sheet. So we have to record your profit and loss suspense account. If it was your original balance sheet or if it was your final balance sheet, we cannot record the profit and loss suspense account because profit and loss suspense account is a temporary account. Whatever value that is there in the suspense account, it has to be transferred to the actual account before the closing of your financial statements. Okay, so total should come to rupees 2,34,000. And that is your balance sheet.